Hello everyone, this is Ricey and welcome to my channel, The Quest for Wealth. In this video, we will talk about or evaluate the biggest bank in Canada, and this is Royal Bank of Canada. Let's get on to it.
The stock valuation of the Royal Bank of Canada is divided into three parts. The first part is the background of the company. The second part, we will identify the financial health of the company, whether or not it is actually growing and turning a profit. And the third part is to make an educated guess on whether buying the stock now is a good decision or not. According to the financial highlights of the report of the company in 2020, the Royal Bank of Canada has got the number one market share when it comes to investment banking in Canada. The company has got 17 million clients and one of the biggest banks among the largest in the world based on market capitalization. When we say market capitalization, this is the stock market value of the company. RBC is Canada's largest financial institution with 150 billion Canadian dollars of market capitalization. This therefore identified that the company or RBC has got a stable footing in the financial market. The second part of this stock valuation, which is identifying the financial health of the company. In this part, what we want to see is consistency in the growth of the earnings per share, revenue per share, and other key fundamental financial ratios. Let's head over now to Statista. This is the total assets of the Royal Bank of Canada from 2014 to 2020, and this is in billion Canadian dollars. Having a look here, you will find that from 2014 until 2020, the company's assets had been growing steadily, and this is consistent growth, and this is exactly what we want to see. Now, growth in the total assets is not the only factor that we have to consider. If the total assets are growing, we do not want the liabilities to grow at the same pace as the total asset. The net income of the company. Net income is all the revenue minus all the expenses. Again, this is in billion Canadian dollars, and from 2014 until 2019, it has been growing, and in 2020, it actually depleted. Another key fundamental ratio that you will normally hear from investors is the PE ratio. In this case, the PE ratio of RBC is at 12.77. This therefore means that the stock price of the company is 12.77 times higher than its earnings. These days, the average acceptable PE ratio is at 15 and below. So anything that goes above 15 is considered to be an overvalued stock. In this case, apparently or potentially, RBC, according to its PE ratio, it's not truly overvalued, but really 12.77 in its technicalities is overvalued already, but not as overvalued as what the rest of the stock market is. In the past 13 years, the highest PE ratio of RBC was 16.16, the lowest was 8.72, and right now the median is at 12.44. The next factor that we have to look at is the price to book ratio. The acceptable number here is 3 and below. In this case, this is 2.09. This could be an undervalued stock. Looking at the book value per share, you will see here that it grew from 26.80 in 2010, 33.36 in 2015. That's 5 years apart. And then in 2018, tremendous growth, which is at 42.60. And back in October, the fiscal year ended, 2020, it grew to $44.66 per share. In percentage value, the growth had been remarkable. So in 2010, it grew at 12.2% as compared to 2009. The biggest growth of the company so far is at the trailing 12 months, which is 23.9%. The earnings per share measures the amount of the company's net income. This is net income. The book value per share is taking all the assets minus all liability. If we will look at the EPS growth rate here, it has indeed been growing. There are years, which is in 2015 and 2020, that it did not grow. Revenue per share, again, is the income of the company divided by the common stockholders number. And this has been growing as well. If you will have a look overall, the company has been growing. The next ratio that we will look at is the return on equity. For the return on equity, this is normally reflected in percentage, and the general acceptable return on equity is between 15 and 20%. If it goes higher, then even better. And if you will look here with the return on equity of RBC from 2010 until 2020, it has been hovering between 14% and 19%. This is an absolutely good factor, meaning the company has been employing its cash to expand the company. Another factor that we have to look at is the return on invested capital. ROIC measures the return a company earns as a percentage of the money shareholders invest in the business. A higher return is always better than the lower one. A common benchmark for evidence of value creation is return in excess of 2%. Therefore, that means if the ROIC is more than 2%, then it is a good ROIC. If it is less than 2%, then the return on invested capital is actually not efficient. The ROIC from October 2010 until October 2020 has been hovering between 12% and 16%, which is absolutely way higher than the acceptable value of 2%. Therefore, if we consider ROE and ROIC, we can say that the company is growing and the company is employing its assets and cash to further expand the operations and financial health of the company. Another important factor we have to look at is debt. Debt is the liability of the company. Again, as I mentioned in my previous video, the acceptable debt of a company, for me personally, is that it is equivalent to maximum 5 years of the company's earnings. In this case, the debt or liability of the company is equivalent to 1.33 years of earnings, which is absolutely a home run. Now, having identified the financial health and viability of the company, having identified the PB ratio, the total assets, earnings per share, ROE, ROIC, and debt of the company, therefore, we can make a conclusion that Royal Bank of Canada is indeed a financially stable and a financially healthy, financially sound company. The next question now is, and therefore it brings us to the third part of this valuation, is that whether buying the stock now is a good decision or not. And looking at this, and do note that this is in US dollars, as I mentioned a while ago, the stock price of the company is almost at its highest point at 100.35, but then even at $100.35, the PE ratio of the company is at 12.77. The PB ratio is at 2.09, therefore it is undervalued as well. I would say that if a person or if an investor is a long-term investor, meaning 5 years and above, then this would make an absolute sense to invest. If you will have a look in 2014, the company's stock price peaked at 74.05, and then it absolutely dropped at 46.11. It was not until 2017, that's 3 years apart, that the company reached its peak again at 75.63. It was only after 3 years that the company was able to reach that peak of 2014, and then it dropped again and then reached its peak at the same year. The peak again was reached in 2018, and then it went sideways and then dropped again, and it never reached that peak, this peak of 2018 in January until 2021 of February. And therefore, that is about 3 years of difference, really. So right now, what we're trying to get at is that if an investor is a long-term investor, as what we have seen here, it takes about 3 to 4 years before Royal Bank of Canada, basing it historically, it takes 3 to 4 years, up to 5 years really, before it reaches its previous peak peaking and dropping is a common notion when it comes to stock market, and this is definitely, it also warrants the peaking and dropping of the RBC. Now, again, if an investor is a long-term investor, meaning 5 years and above, then definitely RBC is a good purchase. But if an investor is a short-term investor, meaning 1 year or 2 years, even 3 years, this could be a questionable purchase because basing it historically, it takes about 3 to 4 years before RBC reaches its previous peak. So there you go. This is the stock valuation and the thought process that comes with it whenever I look at the various key financial ratios. Let me know if this made sense to you. How did you find it? Was it valuable? Was the thought process clear? Was it understandable? Were you able to understand the considerations and were you able to understand the reasoning behind every single financial ratio that we discussed? And let me know if you think that RBC is a good buy, or would you rather move on and look at another bank? As a matter of fact, I am absolutely looking at valuing another stock, which is called the TD Bank, the second biggest bank in Canada, and I hope to see you in that video. Thank you very much indeed. I hope this was of value to you. If it was, please do like, share, and subscribe, and I will see you in the next video.